a drop overall in the 9 months, but can you contextualize the impairments outlook? It's the one thing that everybody's looking at in every bank report. Let's start there, Raghavan. Good morning. The impairments as they stand and the outlook.
Good morning, Manas. Good to talk to you. Yes, 5.7% reduction, but if you could see, clearly the net non-performing book, if you look at it, it's relatively stable. 5.63% is the total non-performing book. And we have a specific provision coverage of 73%, and also including risk reserve. One good thing is Central Bank of Qatar has been insisting since financial crisis we should build risk reserves. That's a great enabler. Now, if I include that, that is also to be used, invoked in terms of contingency. That is now 111% coverage. So overall, net operating income has grown by 6.6%. Net interest income has grown, again, 6.6%. So we are comfortable with the market momentum. We have adopted a five-pronged strategy: remedial management, restructuring of debt, revenue enhancement, cross-selling, rationalization, and again, remodeling the business. This is what exactly keeping us financially stable. The system itself is now functional, and the capital adequacy is quite meaningful.
And obviously, that kind of message, Raghavan, has got ramifications for the language you'll use around the dividend. Where are we on that discussion?
The regulators have to decide. These are changing times, challenging times. A long-term perspective is important. Last year, we skipped the dividend. We conserve the resources. Our capital adequacy stands at over 18.4% in terms of total CAR. Even CET is around 11.4%, and Tier 1 is over 17.5%. So the regulators have to decide. We can produce, a decent.
Are you optimistic?
Payout,
Are you optimistic? Can I push you a little bit, Raghavan? Standard Chartered say they are mulling. HSBC are saying to me that they are talking about a conservative dividend. How optimistic are you that you will be able to restart?
I think conserving the resources is the best choice. Regulators and the board of directors have to have a strategic direction, long-term visions, because we still not sorted out the COVID pandemic. We don't know the impact for next year. We are all optimistic, cautiously optimistic. The potential impact for the first 6 months, it means, again, stress in the system. So the liquidity crisis is well managed. It should not leave it, move to solvency issue across the globe, and especially in the Gulf states. So I think it's a balancing act.
Okay.
It's the right choice. Standard Chartered is right, and the rest of the global banks are also, I am sure, that they will have a conservative dividend policy.
Can I talk to you about the state of play in Qatar? We're all grappling with lockdowns, close downs across the world and new rules, but Qatar's health ministry has sharply limited the number of people coming into the country. I mean, I'm even talking about residents who've been abroad for months. So what sort of business impact are you seeing on the bank from that policy? Is there any ramifications of that in terms of credit card use, bank loans, overall business?
Let me put you in perspective. For the first 9 months, the combined, the bank's balance sheet shows a credit expansion of 6.8% and the deposit growth of 3.4%. Retail, which is specifically asked, is grown 4.6%. Real estate has grown by 4%. And again, service sector has grown. Qatar has got both hydrocarbon as well as non-hydrocarbon. They are easing the real estate rules now. They have opened up real estate sectors now. That is also attracting momentum now. The correction is there, but definitely there is no major downward trend. We are seeing consumer retailing is also slowly but steadily picking up. And we need people for the project space. And again, with the easing of business, they have taken steps like public-private partnership model, easing the investment rule, easing the real estate, as I said. All these are business enablers for competitive offerings. Qatar will hold good. And you have seen the IMF forecast next year. We are going to do around 2.5% growth. It means market will expand by, credit expansion will be not less than 5 to 6% again.
But in terms of the challenges, Raghavan, I mean, we've only got one country in the G20 growing. That's China. We've got rolling lockdowns in Europe. Do you really think that you can deliver those kind of growth? I'm talking about specifically, for example, in the residential and in the commercial property market. I mean, structurally, your market has changed. Are you going to be able to make the same number of loans next year of the same quality to residential and commercial as you made in this 9 months?
We live in an interconnected, interdependent world. So essentially, the monetary and prudent policy has worked. Prudency has prevailed. So now what we need to be, understanding from the lessons learned, we have to be conservative. There is a definite correction in terms of real estate, and the valuations are getting changed. There's a diminution in every asset class. Everybody is losing money. So I think we should be conservative. And real estate sector, even though this year has grown by 4%, possibly 2 to 3% growth is possible because of Qatar needs modernization and airport, seaport, road, hydrocarbon growth momentum. All of modernization still left out, and the Qatar government budget is an enabler. This year they trimmed it by 16%, and again, next year also you'll have a conservative budget, but still a moderate growth is possible in most of the sectors.
Raghavan, with that moderate growth, let's take that as our jumping off point. Are there any sectors that you will now pare back, reduce, or not lend to going forward? In other words, fundamentally change your lending criteria? I
have taken a step. I will reduce my contract financing. I used to have nearly 40% of the market share. Today, it's nearing 20%. It's a conscious decision. Systemic risk we have seen across the Gulf, not only Qatar. And there are definite legal risk. They can't dispute in terms of commercial contracts between the project owner and the contractor and subcontractor is not getting resolved within the standard time. And there are performance guarantees are getting encashed to create liquidity. A lot of ethical governance is required and systemic risk to be mapped. I think conscious decision is to slow down on the contract financing unless there is a public-private partnership model. A total protection is required to support the long gestation period, and unless that is the legal framework is completely mapped, I don't think it's the right decision to move on to contract financing.